Friday, May 1st. Ordinarily, the first Friday of every month, we get job data for the prior month, not this month, because the first of the month fell on the first. The Bureau of Labor Statistics, in its infinite wisdom, has skipped the date out to next Friday. It'll be a big day. Every one of these is going to be a big day now that the Fed is on hair trigger, if it is. The big news, this week we got the first quarter gross domestic product, GDP, which was nearly flat. It was a gain of 0.2%, which ordinarily should help interest rates, and yet interest rates rose all week long. So what is going on? Everybody wants to know. Even one of the best investment managers in my hometown wanted to know yesterday what happened. So take the tape back. Take the tape back to late last fall. The Fed is on hair trigger to increase interest rates. Europe and Japan are cutting interest rates, going to quantitative easing, cutting so hard that they're also cutting the value of their currencies. Rates are going to go up in the United States, the value of the dollar rises. Dollar up, the rest of the world down. So money flows to higher interest rates rather than low. If you want to take advantage of a strong dollar, you have to buy something that's dollar denominated. So money slashes to U.S. bonds and stocks. Stocks up in price, bonds up in price, yields down. Hit the maximum end of that early in February. We've waffled around unchanged for the last 6-7 weeks. Now all of a sudden the U.S. economy is not that strong. So maybe the Fed's not coming quite as fast or as hard as it was. The European economy is doing better because the dollar used to be really strong, helping European exports and the European economy. Spain is suddenly one of the strongest economies in the world. And so what happened in the winter is just in the process of rebalancing. As the copy nearby says, I don't think there's anything really going on. The Fed still very much wants to lift off from zero. When they will do so, nobody knows. It could be as early as June, but it's not likely to be. Fall is more likely. The state of the U.S. economy has most of the world confused about why it is not picking up speed. And as in the copy nearby, it makes perfectly good sense to me. We're in a time of excessive labor, excessive commodities, excessive energy, excessive manufacturing goods, and all of that's made worse by China and Germany running trade surpluses that make it hard on everybody else. So long as that continues, I don't think much happens. The mortgage rate's easily above 4 at any time. Probably not going far, but we could wake up any morning at 4.25, even 4.5. But my suspicion is that it stalls out there. We stay close to 4, open-ended. Good weekend.